Hello everyone, Ed Lyon here, and thanks for joining me for this special Certified Tax Master Conference preview. Today I want to talk a little bit about the Certified Tax Master program, but I'm primarily here to talk about the inaugural conference that we're hosting May 22nd through 24th in Dallas, Texas. I'm going to walk through the agenda for the conference. In fact, you should see the detailed 3-page agenda in the handout section of your GoToWebinar interface. I'm going to walk through just a little bit of the content of the program so that you can get a sense for what we're going to be looking at and what we're going to be discussing during those 3 days, and then I will take your questions. I want to start by saying that I've done a lot of stuff here at Tax Coach since Keith and I launched the company 12 years ago, but I think this program and this conference will be what I am most proud of since we launched the system itself. We've put a lot of work into this program. We've taken a lot of input from you, the members, over the last 12 years, learning what it is that you want from us to help make you better tax planners and more effective tax business owners. And we've rolled all of that into what should be a delicious Texas barbecue, 3 days of tremendous learning, tremendous networking with your Tax Coach peers from across the country, and a great discussion of the opportunities that are lying ahead of you in this program and in your business. All right, first I want to talk just a little bit about the Certified Tax Master program itself. We are building this as a designation and ongoing training and membership program for CPAs and enrolled agents who want to incorporate financial planning into their business. And that really is the specialized hook. Now, by incorporate financial planning into your business, we mean that very broadly. It does not mean that you have to be a practicing financial planner. It doesn't mean that you have to be involved in product sales or wealth management or estate planning and anything like that. The program is designed to help you become a more valuable advisor for your clients by incorporating these financial planning issues into your practice. Specifically, we want to give you a competitive edge in the face of technical change. We all see how artificial intelligence and machine learning is working to take away some of our core businesses. Change is coming, whether we like it or not. We need to remain competitive in the face of that technical change. And we need to do it by giving clients what they really want. We've talked about this over the last 12 years. People hire you to prepare tax returns and handle bookkeeping because they have to. They hire you to do tax planning because they want to. Fortunately, that's not just the most valuable service that you can offer. It's a service that at this point can't be outsourced to artificial intelligence. Towards that end, the CTM program is going to build on top of what Tax Coach already does to give you tools and resources to build your businesses, to build an elite specialized community, and to support tax plan implementation. This is important, and we'll see this as we go down the road. All right, I've got a slide on the program agenda, but what I'm going to do right now is we're going to take a look at the actual agenda. Now, this is not a final agenda. There may be changes, but the program is going to look a lot like this. We're going to start out by introducing the concept of Tax Professional 3.0, which we'll get to in just a minute, and introduce the concept of the fractional family office. Discuss how your business fits into your client's overall financial services needs. Then our next session from 9:50 to 10:40 will be how to create demand for tax planning. And I should say that there's a reason these are 50-minute sessions rather than 45-minute sessions. We are working to get the program qualified for continuing education credits. We don't have that nailed down yet. but we do have a provider identified and an agreement that we're working on that we will be able to offer continuing ed credits for the program. This will be the first time that any tax coach program has offered continuing education, and we're doing it because you've asked for it. All right, after the first morning break, we're going to talk about how to sell a tax plan and how to price a tax plan. For those of you who are new to Tax Coach, this will be a great foundational presentation. For those of you who are veterans, you'll see a little bit of what your most successful peers are doing. We do have lessons learned over the last 12 years to incorporate in this presentation. Next, we're going to jump into the actual technical tax planning, and that's what the bulk of the 2.5 days is going to be about. We're going to start by illustrating the timing shifting code product model and the red light, green light model. And I'll be talking about the red light, green light model in just a couple of minutes. Those of you who have already seen the charitable giving PowerPoint presentation on the seminar kit section of Tax Coach may already be familiar with this red light, green light model. This session will be when we roll out the tax planning roadmap, which is actual business and personal returns with specific line items identified for mistakes and missed opportunities, along with specific opportunities identifying what you can do with the information in those lines. This will be a great resource for new and experienced tax planners to walk through, particularly if you're new, if you're looking for a foundational tax planning education. You'll be able to sit down and compare a client's return to the tax planning roadmap, which will take the form of an actual tax return, and you can look and you can see where those opportunities are and what you can do with those opportunities. After lunch, we'll jump into some of the technical business entity planning with S corporations and limited partnerships as S corporation alternatives. The next section we're going to devote primarily to C corporations, including management corporations and Section 1202 stock, talk about turbocharging business deductions and hiring family. After the afternoon break, we're going to discuss fund deductions that nobody else discusses. These are things like the Augusta rule and the on-premises employee athletic facility that are high-value opportunities that most other tax professionals miss or ignore. Finally, we will talk about medical expense reimbursement plans, health savings accounts as an alternative to medical expense reimbursement plans. We'll finish the final segment with a non-qualified retirement, with a qualified plan survey and commentary, and finally non-qualified retirement plan alternatives. And as you'll see when we get to Wednesday, this is a really big area. It's not something that we've traditionally highlighted in Tax Coach, and it gives you great opportunities to talk about tax planning with your W-2 clients and your retiree clients. This can open up tremendous new markets in addition to the business owner clients that we've been talking about. All right, Tuesday, start bright and early at 9 a.m. We're going to talk about the vision of a planning-based practice and some potentially new practice models for you. The future's so bright, you're going to need shades. From 9:50 to 10:40, we're going to talk about charitable giving. We're going to start with some foundational charitable giving concepts. We're going to discuss advanced planning with charitable trusts, and we're going to discuss special purpose charitable vehicles. After the break, we'll come back, we'll talk real estate investor issues. We're going to survey those issues, including passive loss limits and passive loss rescues, along with real estate professional status, dealer status, and developer status issues. Finally, before lunch, we're going to cover 4 home run planning strategies for business owners with lots of excess income. Those will be the closely held insurance company, the interest charge domestic international sales corporation, the S-ESOP, and the monetized installment sale or M453 strategy. Now, obviously, we're not going to be able to make you a world-class expert in all 4 of those strategies in 50 minutes. The goal here is to identify the mistakes and the missed opportunities that the clients are making and identify the planning opportunities. And in this conference, give you the information you need to credibly and confidently recommend these strategies for your clients. There will be more information on all of these strategies in the ongoing educational program and resources that you can take advantage of to implement all of these strategies. But you'll know what to look for, you'll know what recommendations make sense and don't make sense, and you'll know where to go for additional help. After lunch, we're going to jump into some of the investment-oriented strategies. We'll start with a survey of different investments and the different tax consequences for all of them, cash, bonds, and equities. We'll discuss passive income generators, oil and gas investments, and tax-engineered products. Finally, we'll finish with a very important discussion of something that a lot of CPAs and EAs aren't familiar with. That's the concept of mutual fund tax overhang and separate managed accounts. I've got a couple of people who have asked if this will be rebroadcast. Yes, we will be recording this. I'm recording it now, and we will have this available on the Tax Coach site tomorrow afternoon. All right, after the afternoon break on Tuesday, we will be discussing insurance and annuity products, the good, the bad, and the ugly. There are some very good, there are some bad, and there are some very ugly. And you might be surprised at what you learned in this session. It's not simply rah-rah cheerleading for insurance and annuities. They're powerful products, but they have to be used properly. Finally, we're going to finish with a terrific discussion on some advanced strategies that most advisors have never heard of that you should know about, and finish up with a daily wrap-up and Q&A. Wednesday morning, we're going to start at 9 a.m. with tax planning for retirement. We're going to talk about the seed growth harvest model, which I'm going to present to you in a few minutes here. And we're going to talk about specific strategies for retirement distribution planning. This is a tremendous door opener for retired and pre-retiree clients. Great way to increase your business in those markets. After a break, the next morning session, first half of the morning session, we'll finish up with tax planning for Social Security and Roth IRA conversion planning. Morning break, we're going to finish with a discussion of financial services in a CPA and EA practice. We're going to talk about why to offer financial services at some particular level. We're going to talk about how to offer financial services. And we're going to introduce the financial gravity model for offering financial services through financial gravity. Now, very important to say up front, we think financial gravity offers a terrific model for CPAs and enrolled agents. If you decide that you want to offer financial services, you certainly do not have to do it through financial gravity, even if you choose to join the Certified Tax Master program. There's no requirement that you pick any specific model that we're going to discuss for financial services. However, you will probably discover that the financial gravity model is at least worth a very close look. Finally, we're going to finish with a deep dive on the CTM program itself, the CTM program benefits, and at 12:40 we will wrap it up, have a final Q&A, and you'll be able to get to your flights out of Dallas-Fort Worth. The conference is at, I believe it's called the Dallas Lakes Hilton Conference Center. Frankly, it's a blandly anonymous conference center hotel outside the Dallas-Fort Worth airport. If you haven't been to this hotel for a conference, you've been someplace very similar. All right. So that is the program, and of course, you do have the handout that you can download from GoToWebinar. Take a look at it in greater detail, and if you have any questions about the specific agenda, feel free to present them to me. Have a member asking, will the CTM conference be recorded for future review if I attend in person? I'm pretty sure that it is going to be recorded. I'm not sure what portions of it are going to be available for future review. However, all of the technical curriculum from the conference will be available for future review if you attend in person. All right. Now I want to introduce the Tax Pro 3.0 concept that I mentioned earlier. And this is why we've created the CTM program in the first place. So, most of you who attend the conference are going to fly in from someplace. You're going to get to the airport, and you're going to take probably an Uber to the conference hotel. It's just about 10 minutes away from the airport. It's not an expensive Uber ride. You don't have to wait for a shuttle bus. There's probably a shuttle bus available, but who wants to wait for it when an Uber is just a few bucks? And it's a nicer ride than a taxi cab, than the same taxi cab you would have taken 5 years ago if we'd had this conference 5 years ago. Uber is an example of technological change, throwing a real monkey wrench into the taxi cab industry. And it's happened across the country. Taxi drivers are up in arms. Taxi driver associations are all looking to pass legislation to restrict Uber in various locations. They simply can't compete. Right now, Uber offers a better service at a lower cost. We're all familiar with Amazon. I'm betting that most of us on this call are Amazon Prime members. But Amazon is introducing a new location that revolutionizes even the Amazon model. It's Amazon Go. You go into the store, you pick up the stuff you want, and you walk out. And you don't have to check out. You don't actually pay at the store. Instead, Amazon has an app or some other whiz-bang thing, technology on your phone, and it doesn't need to have you stop and check out. Amazon will bill you for what you take out of the store. Technology is changing everyone's businesses, and it's changing our businesses too. So the question is, which kind of a tax professional are you right now? Are you a 1.0, are you a 2.0, or are you a 3.0? The Tax Pro 1.0 has made a good living for the last years or the last decades offering traditional accounting services, tax preparation, individual tax preparation, business tax preparation, probably some sort of accounting, probably some sort of payroll. And maybe you're offering it all yourself, doing all the work yourself. Maybe you've hired a staff. Maybe you've got a bookkeeper or two. Maybe you've got an accountant, a CPA, or an enrolled agent on staff so that you can leverage their time and effort to make your business more profitable. If this is your business, congratulations. You're a very successful Tax Pro 1.0, and you're a dinosaur. And the meteor is hurtling towards you. And as you'll see from the graphic on the screen, the dinosaur here doesn't see the meteor hurtling towards him. The business is changing. It's already changing with QuickBooks, with TurboTax, with H&R Block's tax cut program. Artificial intelligence and machine learning may eat your lunch. They may not, but they're certainly going to make inroads on your business. And I think most of us understand this at a fundamental level. In the past, technology helped you do your job more efficiently. In the future, technology threatens to do your job for you. That's a huge difference. Huge difference. And if you don't think it's possible, I'm going to throw out one example, and that is the driverless car, something that most of us wouldn't have imagined 5 or 10 years ago. Now, the driverless car isn't just on the drawing board. It exists. Companies like Google and Apple and Microsoft and Uber are investing in driverless car technology. They're not doing it because they hope to be the company that comes up with the breakthrough that makes it possible. They're investing because they already know it's possible. It's here. They're investing because they're jockeying for position. They want market share when the revolution inevitably comes. So I say to you, if your business and your income and your financial security depend on repeating, recording history tasks like bookkeeping and preparing tax returns, there's a meteor headed for you. You may not see it. It may not be here this year. It may not be here next year, but it is on its way. And even if you're nearing the end of your career, if you're 52, 55, 58 years old and thinking, I'm going to ride it out as long as this continues to be a big business, even if you're thinking that you can rest on those laurels, you're probably looking at selling your business to provide part of your retirement income. And ask yourself this, how valuable is that business going to be if the meteor hits? All right, a lot of Tax Coach members have abandoned the Tax Pro 1.0 model, and they are proactive, planning-oriented business owners, not just tax professionals. That's the Tax Pro 2.0. The meteor's still headed towards you, but at least now the dinosaur is turned around and he sees the meteor headed his way. And hopefully he's going to get running on those little legs of his and make some speed away from the meteor. So a lot of Tax Coach members have rejected that Tax Pro 1.0 mentality. They are adding or focusing on proactive planning-oriented business, and that lets them be something more than just a service provider to clients. You need to be more than just a service provider. You need to be a trusted advisor. The problem for a lot of Tax Coach members is implementing the advice. They don't have turnkey solutions to help clients implement the advice that they give. And that's where Tax Pro 3.0 comes in. You don't want to be a dinosaur. You want to be one of those nimble little rodents scurrying around in the underbrush. When the meteor hits and the sky is choked with volcanic waste and the dinosaurs are dying, the rodents were nimble, the rodents scurried underfoot, and the rodents survived. So Tax Pro 3.0 is the tax professional who goes beyond the 1.0 model into planning and goes beyond the planning model into implementation. The Tax Pro 3.0, either on his or her own or as part of a larger organization, is able to offer the client all of the financial services they need to succeed in implementing their financial plan. All right, I want to talk a little bit now about one of the analogies. It's actually a central analogy for the CTM program and for how you can present your services to clients. I want to take a look at how to explain to your clients how the tax code works. Now, they know the tax code is 9 times as long as the Bible, or 17 times as long as the Bible, or however many words it is, 70,000 pages, 300,000 words. I see different statistics all the time. It's a mess. This analogy gives you 2 pictures to explain to your clients how the tax code works. So I want you to keep this analogy in mind as you walk through the rest of this presentation, as you make your decision to attend the CTM conference, and as you sit down to explain the tax code to your clients. The red lights are where you have to stop and pay tax. The green lights are where you don't. So let's take a look at the very first section of the tax code, section 1A. And This is in as plain a language as the tax code can muster up. Tax imposed. There is hereby imposed on the taxable income of every married individual, as defined in section 7703, who makes a single return jointly with his spouse under section 6013, and every surviving spouse, as defined in section 2A, blah, blah, a tax determined in accordance with the tax table. It's pretty straightforward. Joint filers owe tax, and here's the amount. We can call that a red light. But then the tax code starts to switch to green lights. Look at section 101. Gross income doesn't include life insurance death benefits. That's not a red light. That's a green light. Section 105B. Gross income doesn't include health insurance or medical benefits. That's a green light. Now look at section 162. Businesses can deduct ordinary and necessary expenses of carrying on a trade or business. That's a green light. Section 170. You can deduct charitable contributions, subject to regulations, blah, 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 but still another green light. Section 179. You can choose to treat the cost of Section 179 property as a deduction instead of a capital expense. That's a green light too. Here's the bottom line. Most accountants, when they look at their clients' taxes, focus on the red lights. And yeah, that's important. Blowing through the red lights is how you get in trouble. So they want to keep you out of trouble. But the tax code itself actually has way more green lights than red lights. And if you just look out for the reds, you miss all those opportunities to save with the green. That's why we all want to focus on proactive tax planning. Yes, we'll tell our clients where they need to stop, but we'll also make it a key part of our marketing and value proposition to look for those green lights that most accountants miss. And we'll let clients know why that makes us different from our competitors and more valuable than our competitors. So we're going to spend the rest of the presentation talking about those green light opportunities. And in the end, there are 4 main buckets of strategies that you can use to cut your clients' tax bills. We've got timing-based strategies, like using 401k deferrals to shift today's tax bill to tomorrow. We've got income shifting strategies to move taxable income to lower bracket taxpayers like your children or your affiliated C corporation. We've got code-based strategies like Section 105B that may let you deduct your family's medical bills as a business expense. And finally, we've got product-based strategies like separate managed accounts and insurance. Now, here's the thing. Most CPAs and enrolled agents are perfectly comfortable with timing, shifting, and most code-based strategies. They may not be proactive in presenting them, but they're at least comfortable with them. They're much less familiar with and much less confident with product-based strategies. So that's a key to the CTM conference, and a key to the overall CTM program is to incorporate those product-based strategies along with the timing, shifting, and code-based strategies. All right, I want to pick one specific technical topic to discuss today and let you see the amount of information that we present on it so you can get a sense of the depth that we go into and the opportunities we discuss in the overall 3-day conference. And I have chosen charitable trusts, specifically the charitable remainder unitrust. Now, this will come on Tuesday morning when we discuss overall charitable giving strategies. And if you remember from the handout, there were 3 different areas to discuss. The first is charitable giving basics, the second is advanced planning using charitable trusts, and the third is special purpose charitable vehicles. So the charitable trusts really are the next step up the charitable giving ladder, and probably the most common vehicle for major gifts, so we will spend a fair amount of time there. Again, I'm not going to make you an expert in charitable trusts by any means, but I can open your eyes to some planning opportunities that you and your clients may not have already considered. Now, before we get into specific types of trusts, let's lay down just a bit of foundation. A trust in general is simply an arrangement where one person, called a trustee, holds property for the benefit of one or more other people, called beneficiaries. And in the case of charitable trusts, there are generally two beneficiaries. There's an income beneficiary who gets an income for a period of years or a lifetime, and there's a remainder beneficiary who gets what's left over after the income interest ends. Now, a charitable remainder trust, or CRT, is usually established to avoid tax selling appreciated assets. That's because the trust can do something you can't, and that's sell assets without paying tax on the capital gain. So the usual course involves transferring something like a business or real estate to a trust, letting the trust sell it to avoid tax, and then paying an income from the trust to the grantor for the remainder of the grantor's life. So the first thing you're going to do with your client is to establish the trust itself. Now, this isn't especially difficult. In fact, the IRS provides template trust documents that your client's attorney can start with. We even have some of those documents on the Tax Coach website. But this really is not a do-it-yourself job. You can't just click on LegalZoom.com and spit out a document. Next, you're going to want to decide how long the trust will last. There are two main decisions you'll have to make, and both of these will affect how much you get to deduct. How long will the trust last? And second, how do you want to take your income from the trust? So as far as time is concerned, the trust can last for your individual lifetime. It can last for a joint lifetime. Typically, that would be you and your spouse. Or it can last for a period certain of up to 20 years. The longer the trust lasts, the later the charity gets the principal, which makes for a smaller upfront deduction. Now, this may not be a real issue if your primary goal is to avoid tax on capital gains when selling an appreciated asset, but it's certainly worth considering. As for the income itself, there are two main flavors. A charitable remainder annuity trust, or annuitrust, pays a fixed dollar amount every year based on the value of the initial gift. That amount won't grow over time. So let's say you donate $1 million. If you choose a 5% annuity payment, you'll draw $50,000 from the trust every year. You can choose a payout as low as 5% or as high as 50%. Alternatively, you can choose a unitrust that pays a percentage of trust assets every year. This version lets your income grow for inflation if the trust assets grow over time. The minimum payment you can choose is 5%, and there's no statutory maximum. Now, within that general unitrust umbrella, there are 4 different flavors of unitrust. A standard unitrust pays the specified percentage of the trust value every year, whether the trust earns that much or not. So let's say you donate $1 million and specify a 6% payout. If the trust's actual income is 6%, you'll take it. If the trust earns just 2 or 3%, which may actually be more likely in today's low interest rate environment, you'll take the difference out of trust principal. A net income unitrust lets you take out just the net income, whether it meets the specified percentage or not. A net income makeup charitable remainder unitrust lets you use extra income the trust earns today to make up whatever you might have missed in previous years. So let's say you don't need income now, but you want to draw from it in 10 years for retirement. You can invest the trust principal in growth stocks or other assets that don't throw off current income now, then sell those stocks tax-free and reinvest in bonds in a decade when you want the income. In essence, you can decide when you want to turn the income spigot on and off. Finally, the flip trust starts out as a net income or net income makeup unitrust, then flips to become a standard trust after a specified triggering event such as a passage of time or sale of an unmarketable asset. Now, they say a picture is worth 1,000 words, so let's take a look at some pictures to explain the concept. Let's say you've got a business you started with nothing. Yeah, we'll call it a tax practice. And now it's worth $1 million. You're ready to retire and you have a buyer. But how much of that business, how much of that $1 million will you actually keep? Well, if your basis in the business is 0, you'll owe tax on that full $1 million. That means regular capital gains tax of up to 20%, plus net investment income tax of up to 3.8%, plus state and local taxes if those apply, all of a sudden that $1 million isn't looking so good. Now let's say you decide to set up a charitable remainder trust. Your first step is to transfer your business to the trust itself. This is crucial. You can't just sell your asset and drop the proceeds into the trust. You have to transfer actual ownership to the trust so that the trust itself can sell the asset. Once the trust has title to the business, the trust is free to sell that asset. Here's where the first magic happens. The trust is tax-free, so the trust pays no tax on the sale. The trust then reinvests the full $1 million into a more diversified portfolio. Over time, the trust will pay whatever income you specify in the trust documents. It could be an annuity income or whatever flavor of unitrust income you choose. Unitrusts can pay out annually, quarterly, or monthly. Annuitrusts can even pay out weekly if that's what you really want, since the dollar amount never changes. The trust is going to file Form 5227 to report income and distributions. The trust itself is non-taxable unless it earns unrelated business taxable income. Donor pays tax on the distribution. There are some very specific and technical rules governing how those distributions are taxed, involving 4 separate tiers. First, distributions are taxed as ordinary income to the extent of current ordinary income plus undistributed ordinary income from previous years. Next, they're taxed as capital gains to the extent of current capital gains plus undistributed capital gains from previous years. Distributions beyond that are taxed as other income exempt from taxes to the extent of current or undistributed non-taxable income. Finally, any distributions beyond those amounts are treated as having been made from principal. There's not going to be a quiz here. I just want you to be aware that the taxes clients pay on trust distributions don't necessarily correspond 100% with the actual income the trust earns. When the trust terminates, after the period certain runs out or the death of the last income beneficiary, the remaining trust assets pass to charity, and now you're all done. So let's take a look at a case study to see how the strategy can make sense, even if you're Ebenezer Scrooge and you have no interest at all in making charitable gifts. We'll say you have a business for sale. The value is $2 million, and your basis in the business is 0. This is a pretty common scenario, especially for service businesses with no real tangible assets other than expensible items like office furniture and equipment. If you sell the business outright, you're looking at a hefty tax bill: regular capital gains, net investment income tax, and state income tax. If we assume 20% for regular capital gains, 3.8% for net investment income tax, plus 5% for state tax, you're looking at $576,000 in tax, or nearly 29%. You're left with just a little over 70% of the gross proceeds to reinvest. Now let's say you transfer it to a charitable remainder trust before you sell the business and structure that trust to pay out the most miserly 10% minimum you can calculate. Now you're looking at 0 tax on the sale and 100% to reinvest. You'll also get a current tax deduction for the 10% gift, even though you don't lose the use of the money until your death. So the math here is pretty clear. Which would you prefer now? A 30% haircut or a 10% haircut at your death? Now let's look at how much you actually get to deduct. I'm not going to walk through the math here because I'm not sure I really understand it myself, but your deduction equals the net present value of the remainder interest you leave to charity. That in turn depends on how much you give, how much income you keep for yourself, how long you'll be taking that income according to the actuarial table, and the Section 7520 rate in effect when you make the gift. So as you can see from the chart, a single individual age 60 who gives $1 million with a discount rate of 1.8% and keeps a 5% unitrust interest gets a $380,000 deduction. A married couple, both age 60, get to deduct $273,000. The deduction is lower because 2 people who are 60 years old have a longer life expectancy than a single 60-year-old. That means the charity has to wait longer to get its money, so the net present value is less. Finally, a married couple, one age 70, the other age 60, can deduct $325,000. Boost the income interest that you keep from 5 to 6%, and the deduction goes slightly down. That's because taking more income for yourself today means less for charity tomorrow. The main rule you have to watch out for here is this: that net present value of the remainder interest has to be at least 10% of the net fair market value of whatever property you transfer into the trust. Now, some clients are concerned about depriving their heirs of the value of that asset and that gift. If that's the case, clients can consider establishing a wealth replacement trust. This is just a trust that you establish to replace the equity that passes to charity through the gift and at your death. The mechanics are really pretty simple. Once you've established the trust, transferred the appreciated assets to the trust, and sold it, you'll have an income stream from the charitable trust and tax savings from the value of the gift to charity. You simply allocate part of that income or that savings to buy insurance on the life of the donor or donors. You can use a single life policy if the income is payable to a single income beneficiary, or seconded eye coverage if the income is payable for a joint lifetime. If you structure it to qualify as an irrevocable life insurance trust, the proceeds will be income tax-free and estate tax-free. All right, so that's it for charitable remainder trusts. We'll be discussing charitable lead trusts as well in the presentation, and there will be plenty of time for Q&A on the topic. I get a lot of questions on charitable trusts, but they are terrific strategies for avoiding capital gains on the sale of appreciated assets. The charitable lead trust is also a wonderful strategy for a high-income W-2 earner or a high-income retiree. All right, I want to talk very quickly here about one more foundational element of the CTM program, and that is the retirement income planning, how to tap into the W-2 market. We're going to talk a lot about when clients actually pay tax on retirement savings and retirement income. And this is a crucial question. You can pay tax on the seed, you can pay tax on the growth, you can pay tax on the harvest. And there are all sorts of tax opportunities that can let you save tax on the seed, on the growth, or on the harvest, and in some cases 2 out of the 3. The real question is how to take advantage of the most appropriate savings opportunities and how to plan for the most valuable opportunities. So let's take a look at some specific investments. With taxable stock, you don't pay, you don't get any break on the seed. You pay tax on the funds going into taxable stock. You earn the money, you pay tax on it, even though you're dedicating it to a taxable stock investment. The growth, well, you'll pay discounted tax on the dividend income if the stock pays qualified corporate dividends. You've got a rate capped at 20% rather than 39.6%. And then finally, on the harvest, you can pay discounted rates on capital gains, or you can pay no tax at all on gains on property held at death, where you get a stepped-up basis. So you're paying tax on the seed, you're paying some tax on the growth, and you're likely paying some tax on the harvest. Now, let's take a look at traditional IRAs and qualified plans. You don't pay tax on the seed. You get to deduct your contribution, and that means you're avoiding tax on the smallest amount. You're also not paying tax on the growth. There's no tax on the growth of the assets in the account. But you do pay tax, and you pay a lot of tax on the harvest. Distributions are taxed as ordinary income, and you've got required minimum distributions. So the rules force you to start paying tax once you reach age 70 and a half. Now let's look at Roth IRAs and Roth contributions to qualified plans. Do you pay tax on the seed? Yep, you sure do. There's no deduction, but the seed is the smallest amount going in. There's no tax on the growth of the assets held in the Roth account. And finally, there's no tax on distributions. So let's toggle back and forth between a traditional IRA and a Roth IRA. where do you want to pay the tax? Do you want to pay the tax on the smallest amount, or do you want to pay the tax on the largest amount? And in some cases, it'll make sense to pay the tax on the smallest amount. In other cases, it'll make sense to pay tax on the largest amount. But you've got a plan to know which is which. On an annuity, annuities are sold as tax deferral vehicles. But how powerful is that tax deferral? Well, there's no deduction on the seed if you buy a regular non-qualified annuity. There's no tax on the growth as long as it's held in the annuity, but on the harvest, it is fully taxable. You're paying ordinary income tax on the full amount. Not only that, but you've got a last in, first out distribution. You're paying tax on gain until you reach your basis in the contract. Not only that, but if you hold equity investments in an equity index annuity or an equity subaccount in a variable annuity portfolio, you're actually converting capital gains into ordinary income. Now let's take a look at life insurance. With life insurance, there is no deduction on the seed, so you're paying tax on the seed going in. There is no growth on no tax on the growth, and if you structure your distributions properly, there is no tax on the harvest. You can take tax-free loans and withdrawals, you can have tax-free transfers between sub-accounts, and you can have tax-free transfers between insurance contracts. So we're going to spend a fair amount of time when we talk about retirement planning using this model as a way to discuss presenting retirement planning strategies to clients and managing retirement assets for clients. One of the ultimate goals is to show clients how they can get to a zero tax retirement. And again, this is going to open up nice new markets for you in addition to the traditional business owner markets that most tax coach planners have focused on. All right, let's talk about the conference. Has this been good information? Does this intrigue you? Does this look like a model for building a practice that you can be proud to own? If so, you need to figure a way to stand out from the crowd. Right now, there are over 664,000 certified public accountants and 48,000 enrolled agents in America. They are all perceived as having the same expertise. You do not want to be just another apple in that very full bushel of apples. So, the CTM conference, as we've mentioned, is May 22nd through 24th in Dallas. The cost for the conference is just $999. We are really not looking to make this a profit center. We're looking to get you involved in tax planning and give you the training you need to be an effective and confident tax planner, including financial services in your business. We have a hard cap on the number of people we can hold in the room. And in fact, Lisa just let me know today that there are just 11 rooms left in the hotel room block at the Dallas Hilton Lakes. You'll get information on the hotel and on the room block when you sign up. So the rooms, I think, they're somewhere around $119 a night, something like that. I think they're not especially expensive. Dallas-Fort Worth is typically not an expensive market to fly into. The meeting will include your breakfasts and your lunches. And I think we're probably going to do a Mexican dinner on us on Monday or Tuesday night. So the main cost really is the transportation. The seminar itself is not expensive at $999. Somebody's asking, how do I sign up? You go to taxcoachsystem.com/CTM. You can go there right now. You can sign up right now. In fact, I know that at least one longtime tax coach member has signed up for the conference while we've been on this call. 11 rooms available left in the block. The room block is going to sell out, and I'm pretty confident that the conference itself is going to sell out. So there are several of you on this call who I've had one-on-one calls with previously, and I've said, no need to worry. If you're on the fence, go ahead and come join us for this conference preview. Make your decision after this conference preview. If the conference preview has proven to be what you're hoping for and the conference looks like what you're hoping for, it's going to be in your best interest to go ahead and sign up now so that you can get in the room and take advantage of that discounted rate. All right, I'm going to go ahead and take some of the questions here. Yes, we're going to be rebroadcasting this. Will a recording be available? It will be available tomorrow. Is there a refund date for conference fees? Yes, of course. Member says the date runs close to graduation activities, so I won't know for certain until later April if there are award night conflicts. If there are award night conflicts, you're going to be fine. We'll protect you. Somebody loves the dinosaur graphic. I'm glad you love the dinosaur graphic. I'm glad that you can appreciate the dinosaur graphic without being the dinosaur. Will we be offering marketing materials? Yes, we will be offering marketing materials to implement this if you attend the conference. Do you achieve the new CTM designation by attending the conference? Yes, you do. Is it good for non-CPAs? I'm a financial advisor. The program itself is designed for CPAs and enrolled agents, the ongoing program and the ongoing designation. However, as a financial advisor, if you're looking for a foundational presentation on how to do tax planning and you want to become more sophisticated on foundational tax planning than any other financial advisor in your market, absolutely you want to come to the conference. You want to be at the conference. We have a very strong guarantee. I'm a big believer in reversing risk. So if you're on the fence, you're sitting there, you're thinking, well, $999 isn't a lot for a conference with all this material, but am I really going to be able to put it to work? We have a guarantee in writing on that webpage, this will be the best conference you have ever attended. In fact, I'm going to have $1,000 of my own money, not tax coach's money, but my own money in cash in my pocket. And if you decide at the end of 2.5 days that it has not been worth the $1,000, I will refund you out of my own pocket. I'm that confident. I've worked this hard on the material. I've worked this hard on the program that I'm willing to back it up with $1,000 in cash from my own pocket. Ongoing cost to be a CTM, the ongoing fee will be $297 a month. That will include your base tax coach membership, and we will discuss in great detail what the $299 includes at the program. However, by attending this conference, you are not committing to sign up for the program. I think it's very important to take this conference and divorce it from the program. This conference, frankly, it's 2.5 days for us to show off our best stuff. And if at the end of 2.5 days, you can't see it's a no-brainer for your practice to sign up for the ongoing program, then by all means don't. And I'll tell you what, I'm guessing that it'll be over half the people who attend the conference who end up signing up for the CTM program ongoing. That means that I know there will be plenty of people who come to the conference and at the end say, great conference, loved it, well worth the $999, blows away any other continuing education training I've ever gotten, but the program isn't for me. That's fine. You won't hurt our feelings. Any continuing education for EAs? Yes, we are planning on doing that as well. Any more detail on the ongoing program? We'll be releasing information on the ongoing program as we put it together, as we put together the marketing material. Right now, if you're interested in more detailed information on the ongoing program, feel free to call Sarah and set up a one-on-one time for us to call. This is actually, I know for most of you, it's your busy time of year. For me, it's my slow time of year because you guys are busy. So I have plenty of consultation slots available. Can you speak to the difference between this Certified Tax Master program and the Certified Tax Coach program? Absolutely. The Certified Tax Coach program started out under the overall Tax Coach umbrella. and has been spun off as its own independent organization. The CTC program is a terrific program. I'm very proud of the work that I put into helping launch the CTC program. I'm very proud of what Dominique Molina is continuing to do with the CTC program. If you like your CTC program, you can keep your CTC program. The CTM program is a little more specialized. CTC program is a good general tax planning program to make you a better tax planner. The CTM program is designed specifically for those CPAs and enrolled agents who are interested in incorporating financial planning into their practice. So it's a little bit more of a specific program. There's going to be plenty of training on basic tax planning concepts, but there will be more continuing education within the CTM program on product-oriented and financial planning-oriented and estate planning-oriented strategies than you would find in the CTC program. CTC is a good program. I'm proud of it. A lot of people see a lot of value in the CTC program. CTM's a little more specialized, and I think that's where the big difference is going to be. Would this be a good seminar to send employees to instead of the owner going? Absolutely. If you are familiar with these strategies, if you've looked at this presentation, if you've looked at the handouts and the agenda for this presentation and you think that you're not going to get a lot out of it because you're familiar with all of those strategies, but that there is somebody in your staff who you would like to make a better tax planner out of, then by all means, send the employee. I will tell you that there are a couple of tax coach members who are already signed up who are bringing employees with them, and there are a couple of tax coach members signed up who are sending employees, and I can think of one tax coach member who isn't sure if she's going to go or send her employee. It's going to depend on some scheduling issues down towards the end of the year. So absolutely, there will be great value in sending an employee and getting them up to speed on these tax planning concepts. All right, I think that's it for the questions in the queue. How many attendees will be present if you sell out? We're looking at 60. The room, I think, could hold 65 in a pinch, but the way we're going to have the room set up with the dual screens, we're looking at 60. And I think we're going to sell out. I'm confident that we're going to sell out. If not, we're going to be awfully close. So the CTM can replace AllStars. Yes, for those of you who have a business in that direction, CTM can replace AllStars. Question, will there be any coaching programs? There will be ongoing coaching as part of the CTM program, and of course the ongoing AllStars program will be available for CTMs as well if you want to combine both programs. All right, I know a couple of you have told me that you have already signed up during this presentation. I'd like to see more, and I'd like to see us be close to full after today. We've got 76 people on the call, had 76 at the top. Will there be another Panalytics demo or discussion? No, not during this presentation. There will not be. On the other hand, Panalytics is going to be setting up their own series of full-day seminars across the country. I'm not sure if they've released the schedule for their spring seminars, so that would be available probably for a $99 one-day fee. All right. Any other investment for coaching besides the $297 a month? If you're looking for the traditional AllStars one-on-one coaching, that would be the regular AllStars fee. However, there will be ongoing coaching available, ongoing group coaching available as part of the CTM program. A member tells me that the Panalytics seminar schedule is released for after April 15th. I'm going to have to take a look at that myself because I want to do a presentation myself. And longtime member says, FYI, signing up tomorrow, so it will be on a new Amex billing cycle. Dave, I love it. The program is for CPAs and enrolled agents, and I would expect nothing less from a CPA than to delay a day to get the extra 45 days float. Good for you. We will look forward to seeing your sign up tomorrow. All right. All right, we've got a couple of members asking about some specific travel plans, which will work for us. Panalytics is, I'm going to go ahead and answer. Abe, I'll answer that question separately for you. All right, what type of resource manual will we receive? Well, you're going to receive the PowerPoint presentation that I'll be giving at the conference, which is going to be somewhere north of 300 slides. You'll get the PowerPoint presentation and script. You will get a manual that includes collateral material, such as the tax return roadmap, tax returns itself, which is going to be a good 30 or 40 pages. You're going to get collateral material that supports the specific strategies that we discuss. For example, you'll get the tax coach implementation guide and document templates for the 105 plan when we discuss that 105 plan segment. You will get some proprietary certified tax coach materials from Financial Gravity. For example, Financial Gravity uses a very detailed spreadsheet to estimate how much a tax planning client will save and to present the savings and the fee for the tax planning proposal. So you'll get some proposal and some additional tax planning delivery materials. Plus, we're going to throw in a couple of books and some DVDs and some additional collateral material. You're actually going to want to leave at least a tote bag empty so that you can take back materials with you. Just signed up, need link to the hotel. That should be available in the confirmation material that you get from signing up. We will go ahead and if that material, if the link is not included in the sign up that you get from One Shopping Cart, I'll make sure to post it on tomorrow's Wednesday member call-in. Otherwise, you can call. It is the Dallas Fort Worth Lakes Hilton Conference Center, and you can call and you can access the room block that way. Okay, no, a member says that settles it. We can't bring the kids if we need to leave extra space in the luggage. Actually, Tate, one of the strategies we're going to talk about is hiring your kids for your business. So if your kid is old enough to carry the tote bag on the plane, because the kid doesn't have a briefcase, the kid's not going to be bringing the laptop or anything on the plane, I think you should hire your child to tote the materials back to Seattle with you. Is there a separate website for CTMs from the regular Tax Coach site? We will be adding material. We're actually in the process of redesigning the entire Tax Coach website and opening portal. We'll have a preview of that available at the CTM conference, but yes, there will be an additional material that links from the Tax Coach site if you link in as a CTM. It's the same way the Tax Coach site works now. If you're an AllStar or if you're a wire service member, when you link into the Tax Coach website, you get access to additional sections that aren't available for regular Tax Coach members. Just signed up and got my hotel reservation. Can I schedule a flight that would put me in the conference at 10 a.m.? Is the intro to the whole program essential? The intro is pretty essential, although it's worth mentioning that the hotel is 10 minutes from the airport, so you can get into the conference pretty quickly. Having said that, the technical education part is going to start at, I believe, after the first after the first break sometime around 10:50 a.m. So you will miss material, but you'll be able to make it up. Another member in Florida says, yes, best to fly in on Sunday evening. Do we know how many hours of CPE we would be offering with the training? I believe we'd be looking at 20 hours of CE for CPAs and maybe 14 hours for enrolled agents, somewhere in that neighborhood. Don't sign up for the CPEs. The education is going to be well worth it. The CPEs are just a bonus. What time are we done on Wednesday? We're done at 12:40. So you'll have plenty of time to get a flight out in the afternoon. Will there be networking and booze at the hotel Sunday evening? Absolutely. Absolutely, there's going to be networking and booze at the hotel Sunday evening. 20 hours of CPE is great, and it really does add to the incentive. Well, good. I'm glad we're working on the CPE for you then. I've had several other people tell me in comments that they have signed up within the last 15 minutes. So good. Looking forward to seeing all of you there. Member says, nice hotel, been there. Yeah, it is. It's a nice enough conference hotel at Dallas-Fort Worth, and if you haven't been to this one, you've been to one just like it at the Atlanta airport or at the Chicago airport or maybe somewhere in Denver or Las Vegas or some other conference city. All right, got your hotel. Good to hear it, Susan. Looking forward to seeing you again in Dallas. All right, looks like that is it for questions in the queue. I'm going to go ahead and turn off the recording so that I can start formatting it to post on the Tax Coach website. Thanks, everyone, for joining, and look forward to seeing you there in Dallas.